And lo and behold, after a weekend, we had 100 people sign up and pay us for their first NatureBox. The problem with this is NatureBox didn't exist at that point. So these people paid for a product that did not exist, nor did we know how to make it. And so we had a real challenge at that point, which is what do we do now? Do we refund this money that 100 people have paid, or do we force ourselves to figure out how to come up with something to sell to them? And we thought about it for a little while and we said, look, if we are going to start this business, we need to figure out the product side of this business pretty quickly. And I think the lesson learned in that story is to have a bias towards action. I often meet founders that, they're waiting for the capital to come, or they're waiting for, the first engineer to be hired, whatever it may be. And in this case, look, we thought, what is the easiest way that we could test this idea? And we put it out there, getting proof points that it works, getting the proof point that customers like it or want it. And the capital will take care of itself. Many companies fail because the founders run out of gas. I think often CEOs in their heart of hearts know. I think one of the challenges is that boards tend to be really bad at navigating transitions and talking about economics.
I felt this was a masterclass for someone who is really looking forward to build a company and not having right access to the network at this particular time. And sooner or later, we're going to see a lot of bots which are actually validating the ideas, taking baits, and essentially how the funds should be structured or whom to approach. So, what are your takes on the future VC world looks like? Welcome to Passionate Pulse podcast. In this Capital Pulse series, we have another guest coming from a big VC firm and now looking forward to emerge into the investing world where, the founders gets enablement in a much more meaningful way. We'll welcome Gautam Gupta, a former partner at TCV Fund who has acted in multiple ways in the VC firm, as well as a founder of NatureBox, who started with the seed round of $2 million and raised up to $70 million for his own firm, had his own up and downs as a founder, has his experiences that rolled up as a VC, and looking forward to emerge in a much more stronger way to build many founder-led companies. Here we are with Gautam Gupta. I'm honored to have him on this Capital Pulse series. Hi, Gautam.
Hi, thanks for having me. It's great to join you.
Yeah, it's great to see you. Well, looking at your diverse experience, starting with investment to founding and then going back to investment, I'm sure you have a very unique angle in looking at how the founders should be building, what kind of guidance we should be providing to them, and how the companies in general can scale up for the growth. So, what is your take on, as a founder, I would say, when, some founders are going and raising their capital, what are some of those experiences that you can deep dive so that our founder club can get more insights from it?
Yeah, well, the first thing that comes to my mind when we were starting, my co-founder and I were starting a company called NatureBox. So let me just explain what we were doing, and then I'll explain the situation and the takeaway. But NatureBox is a multi-channel brand of healthy food. We started the company in part really because of my journey with the weight loss. Before going off to college, I had really bad eating habits. Luckily learned about nutrition, and I lost 70 pounds in 6 months through diet and exercise. And I've kept the weight off ever since. But I really wanted to try to find a way to help other people access better quality products, better foods, make it more convenient for them to replace some of their junk food with more nutritious foods. And so we started this company called NatureBox. The first thing that we did was we wanted to understand, would anyone be interested in buying this product? And so my co-founder and I put a website up. We, to photoshopped a picture, added a PayPal link, all of this stuff. And we started driving traffic to that website. And lo and behold, after a weekend, we had 100 people sign up and pay us for their first NatureBox. The problem with this is NatureBox didn't exist at that point. So these people paid for a product that did not exist, nor did we know how to make it. Everything had been photoshopped. We had never spent a day in our lives running a food business. And so we had a real challenge at that point, which is, what do we do now? Do we refund this money that 100 people have paid, or do we force ourselves to figure out how to come up with something to sell to them? And we thought about it for a little while and we said, look, if we are going to start this business, we need to figure out the product side of this business pretty quickly. And so we thought, okay, well, why don't we just figure out something to send to these people? We ended up going to the only place we could think of, which was Costco, and buying a bunch of bulk products. We filled up 2 shopping carts, repackaged them into NatureBox branded bags. And then that was the first box that we shipped out. And I think the lesson learned in that story is to have a bias towards action. I often meet founders that, they're waiting for the capital to come, or they're waiting for, the first engineer to be hired, whatever it may be. And in this case, look, we thought, what is the easiest way that we could test this idea? And we put it out there, and lo and behold, 100 people said, hey, I'll sign up, and these weren't friends and family. These were just random people, on Facebook ads. And so the lesson learned for me is to really just bias towards action. Don't wait for the next hire. Don't wait for the capital. Don't wait for, can I come up with a great name? Just start working towards your idea, getting proof points that it works, getting the proof point that customers like it or want it, and the capital will take care of itself.
But this is something called as a landing page, and you actually ended up getting a good landing page that kind of drive the traction. I think it's one of the concept that many people are testing, especially the founders, whether their ideas are worth pursuing. And what you revealed is an actual story that talks about how the seed round with the $1 million can be raised, and how certain ideas, if you actually got the paid buyers, you better put an action towards it versus thinking whether you're good fit or no. So I think that's a wonderful step. And this was a bold step at that time that you took. Haven't figured out what the tech should look like, haven't figured out whether the right consultations should happen, how a particular persona should be evaluated in order to ship the box.
Yeah,
But
we
just
didn't know any of that. Yeah, and we were still working our day jobs, right? So this was all happening nights and weekends. We were packaging food in my apartment. Literally, I mean, it was just, we were doing whatever we could to try to get this business off the ground.
Yeah, I mean, that's a wonderful lesson. That's the first lesson that, any founder or rather, someone who is passionate about solving certain problems can take. I think today it's even much more simpler. You don't even have to outsource and build those landing pages. There's so good configurative products out there which can help you build the landing pages, literally help you put out to this user metrics and, put out a simple Facebook ad or the Insta ad or the LinkedIn ad. It doesn't take even
Right.
much. $5 a day also somebody can run the ads. And it's a phenomenal way to, take an advantage of what exists today and what the concept essentially is looking forward to do the pilot testing.
Yep, absolutely.
So going forward with that, what really made NatureBox raise $2 million when, when this was looking out so
Yeah.
simple?
Yeah, so we started it's actually interesting. So I was working at the time for General Catalyst, and I had told the partners at General Catalyst that I was thinking about leaving to start a company. And they were very kind. They basically said, listen, we would love to support you. We'd love for you to stay, but if you're committed to starting your own business, we would love to support you. We will invest in the company. Why don't you just come present the idea? And when we had those initial conversations, we thought, hey, we would love if General Catalyst would invest. I think it was 1.5 million or something. I forget the exact number. We presented to the partnership, and we thought, hey, we've got this in the bag. They've already said that they want to invest. They'll invest 1.5 million, and we're ready to go. And at the end of the day, one of the partners came back and he said, listen, we want to support you. We're not sure about this idea. And so instead of the 1.5 million, we would be willing to invest 350K or 400K, something like that. And my co-founder and I felt so dejected, right? We felt so demoralized because we had anchored to this $1.5 million. And now, the answer was coming back that, hey, we like you, but maybe not that much. And here's, 400K. And we went out for a drink after work that day, and we were kind of thinking about, what do we do now? Do we keep going? Do we just kind of call it quits and just say, hey, this was good while it lasted, but maybe not enough demand? And after, maybe 30 minutes of conversation, we kind of looked at each other and said, hey, what would we be doing right now had we raised the 1.5 million? Thought, well, we'd probably be at this exact same bar having a drink, and kind of celebrating the fact that we had raised $1.5 million today. Thought, okay, well, kind of interesting that we're in the exact same place that we would have been either way. And at the end of the day, $400,000 is a lot more than nothing. And so why don't we go and see what we can make of this? That initial 400,000 from General Catalyst turned into, another 400,000 from Redpoint. And then once Redpoint invested, General Catalyst wanted to invest more. And so it sort of snowballed into a $2 million seed round, which was more than even the 1.5 that we had initially wanted. But it wasn't the easy path to getting there. And I think the lesson learned, at least for me, was, the bad news is almost never fatal. Oh, you got to keep fighting and figuring it out. And this was a great case of bad news in terms of not getting the 1.5 million, but great news that we got 400K, and 400K is a lot better than nothing.
Yeah, I just like the idea that, you still bet onto that. And rather than feeling that, you're not good enough, you decided to move forward. But here is a catch, when you were at that position and with General Catalyst, at least you had a clout with you, you had a network
Yeah.
backing you, and, kind of had seen both sides of table because as an investor or at least to someone who is, making decisions of the funds, you pretty much had fair share and idea like what investors technically look in order to invest, and by that means you are all ready. But if I look at the skills and the strengths and the experience in the field, probably you are not there that much versus the other founders who probably are not having access to the other networks. So it's always the game of balancing when you're raising your first sale, and somehow you had a little bit of an unprivileged advantage at that point because you
That's
knew
right.
someone who could just say, okay, let's play with it types, or if
Yeah.
not, yeah.
That's right. That's right. And look, I do think one of the things that I advise founders is you have to lean into the strengths and the momentum or whatever it is that's exciting about your business. And for us, what we were leaning into also was we had paying customers at that point. The 100 customers that we started with had soon become 1,000. And so now we had $250,000 of annual revenue run rate. And so unlike most seed companies, we would go out and the first slide we were able to pitch and present was, hey, we have real revenue and the revenue is growing. And so I always encourage people, figure out what it is that's exciting about your business. It doesn't have to be revenue, right? It could be something else. But really lean into that and make that, the centerpiece of the story, because to your point, we had an unfair advantage that I had a lot of relationships with investors. But that being said, I think what we did with those relationships is ultimately what mattered.
Yeah, and the relationships are still not gonna give you any checks unless there is a real traction.
That's right.
Both sides of the coins had to kind of fall in place. But, leading to that question, when you talk about the networking and the relationships and the cloud that you bring in, how important it is for a founder to think on that lines and, put some intentional efforts while they want to scale up where the idea has been tested. What sort of efforts somebody can take, because not all founders could be, having the good social impacting skills or the EQs to drive and build a network. However, maybe the co-founders or their first staff members basically can bring that kind of an expertise, and somebody can think about, like, we have to kind of balance all the angles so that we move forward and gain the strong network in terms of leading from one point to another.
Yeah, I think for every company, it's a little different. I do think it's really important for one of the founders to take on the job of fundraising and, be the liaison to investors. But I think for every company, it's a little different. Maybe have an advisor or you work with an advisor who can help you, open some doors and get to know potential investors. It's different methods for different companies. The things that I've seen be less effective, I haven't seen cold calling to work very well. I think ultimately you want to try to drive some amount of social proof, and so I do think like working with advisors, talking to people that you may have worked with in the past and say, hey, who do you know, or who can you connect me with? Things like that tend to, I think, work a lot better. Unfortunately, it is a job that can't be outsourced. And so it's one of those things where the founder, even if it's not a skill of the founder, they have to push themselves to try to acquire that skill or at least improve, kind of that investor relations skill over time.
Yeah, I think it also the untapped area where they have to tap in, and if you have to grow wherever in the area, or try to solve the problem in much more meaningful way, you have to think it as if it's a nourishment to that solution.
Yeah.
Yeah. Leading to that, I just have one more question talking about this networking and the cloud. So, for example, somebody who is based in Silicon Valley right here, it's much more easy, accessible. But somebody, like, think about somebody is, building remotely in the possible way where, there is not much of these warm connections exist, but they are solving certain regional problems at their areas, which is remotely not accessible with
Yeah.
VC firms, but they might have to literally go out whoever has the hold of the capital and just asking for their help and building that kind of companies. We do have examples of those as well, who have actually witnessed and talk about building something in semiconductor, and their first investors were nothing short of but the farmers who had
Yeah.
more of a capital. So, what is your take on that? Because right now, through the podcasting and other mediums, we are looking forward to reach out to those remote parts and, have this kind of conversation accessible
Yeah.
to them. So, what is your message to them?
Well, look, I think it's a couple things coming to my mind there. One, I do think scarcity is a great thing for startups, and sometimes the overfunding of companies in Silicon Valley, New York, leads companies to do bad things, right? Leads companies to waste capital or not develop the muscles that they need to run an efficient business or run a durable business. And so I do think although it doesn't sound like it could be a blessing in disguise, right? To be in a geography or an area where capital may be less free flowing. And I think often those have ended up being, if you can build the business, and find product market fit, sometimes those can be incredible companies, and you do it, independent of the influence that capital can have on a business. And so I will say that's, kind of one thought that comes to mind is just that sometimes that can be a blessing in disguise. The second is, I think that you have to be open to capital, sort of from all um, avenues. And so if it's a local entrepreneur or local investor, there's nothing wrong with that. There's nothing that says that, that person, it won't be as helpful as the Silicon Valley VC. I think the reality is that this journey of fundraising gets easier over time as you have more metrics to show and, as you have more proof points. And so the initial capital, even if it just comes from people, kind of in that geographic region, but that allows you to start the snowball effect, or that allows you to start building. There's nothing wrong with that. And you may just have to take a more staged approach, right? Instead of the $2 million seed round that we raised, maybe it's a 500K seed round, and you call it a 500K pre-seed round. And then that way you're able to get off to the races. You can start building the product, start acquiring customers. And then the next round is a 1.5 or $2 million seed round, right? And maybe that's from Silicon Valley investors.
Yeah.
And so you just have to, I think, be flexible about realizing that this is a long journey for most companies. And the most important thing is getting into business. It gets easier with time, with metrics, with proof points, and going from there.
So to that first check, especially raising from the VC firms, now that you have already seen those both sides of the table, what is your take? Like, apart from seeing the right revenue metrics or the science of the particular field or a particular booming industry, apart from that, what is that the VC really looks into? Like, what are those critical metrics in the founder in itself? Like, it could be possible that somebody is solving a phenomenal problem that exists today, for example, energy, just to, state as an example. And they have all the ways that they should be, building the solution, but still fail to raise the capital in many a way. So what is that, X factor, or what are those critical, the unseen factors we could say that the VCs really look forward in founders? I mean, this is basically to help our founders club and, build themselves in a way that if you have to solve the problem, you have to solve the problems in all the angles. It's not just
Yeah.
a solution.
Yeah, so I think, look, every firm is a little different. And I'll talk about generally some of maybe rules of thumb or things that could be helpful. But maybe before we get there, I think two other thoughts come to mind. The first is one of the things that I encourage founders to do when you're putting together your pitch deck is think about what the most exciting thing is about the business, going back to what we were just discussing, but also think about what the biggest risk is. What is the reason that an investor might say no? And look, for us, food had been this terrible category that a lot of investors have lost money in, right? Think about Webvan and some of these .com, stories where hundreds of millions of dollars of venture capital basically got incinerated. And so one of the things that we put in the slide deck was, why has the economics of food, or why are we doing it differently than the companies that had tried in this space previously? And that was a really effective way to present the idea, right? The norm for venture capitalists was, hey, food is low margin. It's a low margin business. How can you build a business around this? And we had to show people that actually produce is a low margin business. And so we're not going to be dealing with produce. We're going to deal with the center of the store, center of the grocery store, which happens to be higher margin, much higher margin. And here's the economics, and here's how you should expect that our company can eventually become profitable. And so we tried to de-risk that immediate question that comes to people's mind when they were thinking about our business. And I think that that's something that a lot of founders can do. I think the second thing that I would tell you is there are many times founders will meet with a venture firm that's simply not the right fit, right? They're not investing at the stage of this company. Maybe they don't even have an active fund, right? They haven't made an investment in 2 years. So these are all the things that I would say, try not to take those meetings more than just simply meetings, right? They're not, that's not the core, that's not the ideal customer, right? If you're trying to raise capital. If a firm hasn't done a deal in 2 years, or they're not investing at your stage and they say no, that's fine, right? Like that, I wouldn't spend a lot of time fretting about, well, what are they looking for and how do I optimize for what they're looking for? The reality is they're just not in, the space of business, or not relevant to the type of business that you have. And then look, I think the general rule of thumb, advice that I would give around what VCs are looking for, I think it boils down to a few things, right? One, is the market, can the market support uh, an attractive, company of scale, right? And that could be an independent public company, that could be a large M&A outcome. Often VCs are trying to understand what is the market dynamic, right, that allows a new company to be built and achieve a significant amount of scale. And so, you want to think about, hey, can I point to successful analogies in this market? Can I point to things, customers that are underserved in this market, right? Gaps in the competitive landscape, all of those things. That's one. Two, is this the right team to do it? Does this team have an unfair advantage, right? Um, the third is around product, which tends to be what's unique about the product, USP, or how do you sell this product? Why is this product interesting for this customer in a given market? And so, often the biggest risk there is not having clarity around, what's different or what's unique. And then the fourth piece is really like around financials. Everything from understanding the pricing model to being able to demonstrate how you build a business of significant scale, and how much capital you need to get there. And so that's, I would say those are the key buckets to be thinking about in terms of, what are the, questions or risks that a VC might be looking for and how to orient the pitch.
This episode of Passionate Pulse is brought to you by Atlantic.net, the official cloud hosting partner of the San Jose Earthquakes and the trusted choice for startups and developers. Get fast, secure, and compliant cloud hosting, plus free credits and a free 8 GB server for your first year. Use promo code PULSE50 at Atlantic.net while it lasts. Atlantic.net, built for builders, trusted by champions. So, do you think there are any, macroeconomic factors also play role, especially in the current economy, to slow down the investments? Like, there could be geopolitical tensions that involves in the world, or there could be, somewhere some sectors which are actually pulling the funds to the LPs, shrinking, and those could also be the reasons why not to take it so personally if certain number of but that you're looking forward to meet the goal.
Yeah, absolutely. I mean, I think geopolitical for sure, right? If your business is in China today, it's very hard to raise US venture capital for that business. I would tell founders though, the macro environment, it's more about perception than reality, because at the end of the day, venture investors are investing today for, a return that might come 10 years out. And so often they're not as worried about what the macro actually is today. And it's impossible to predict what it could be in 10 years. So often that just comes down to perception. And often it's fear, right? So when COVID had just started,
Yeah.
a lot of founders had term sheets pulled, that was not an easy time to fundraise in the, 30 to 60 days after COVID. And then things started to normalize. And so I think the lesson learned for a lot of founders is if you feel like you're heading into one of those headwinds, um, just wait, don't, panic, because a month from now, 2 months from now, things might be very different. And I think tariffs is a good example, right? April, the world seemed to slow down, markets were collapsing, everything was kind of on pause. And then by June, things were normal again, right? And like, now we're in July and, the market's at an all-time high, right? And so the advice would be, if it's macro factors, be patient, don't panic. It changes. VCs are not investing in the macro. And so it's more that they need to feel comfort that their source of capital is, stable and consistent. And once they feel comfortable with that, they will start deploying.
Interesting. So, in your VC tenure, especially, have you observed how the really like the female founders are raising versus the male founder? And is there any a particular experience or, the advice from your experience that you would like to give it to our female founders?
Yeah, I mean, look, I can only imagine like how difficult it is, right? I have not been in that position, but I have a number, I've worked with a number of female founders and been investors in their businesses. It is hard. No doubt about it. It is hard. I think the main thing I would say is obviously, at the end of the day, it's similar advice around traction, like focus on the things you can control, right? Which is the traction of your business. How do you, message what you're doing in the best possible way, around what's exciting, why people might pass, all of the things that we've been discussing. I think where community can be very helpful is leveraging the other female founders in your network, to understand, the investors that are, supportive, and are more open, and more accessible. So I think the community can be very helpful here. But, no doubt about it, like it is a lot harder, I think. And the statistics would show, right, that unfortunately, there's just not enough capital going towards female founders, also, Black founders. It's been a very, difficult many years to fundraise. Well, I do think that there's a little bit of optimism there, which is, you know, female founders tend to be very happy to help and share. I think that's where, leveraging the community and relationships can help a lot.
Oh, do you have any example, like, when you were sitting on the investor tables and some of the founders, female founders especially, have walked in and um, do you have sort of have experiences to share, that kind of give us the current scape of, how VCs tend to not look at that gender bias, but they tend to pursue the idea because their money is not betting whether it's a female or a male. Their betting is on the solution that's going to scale up, how gratefully the founders are, taking it further. So when it comes to money, there is no relation, to be honest, neither
Yeah.
gender. So, what do you have any experience or a case study to unfold that gives us, more confidence about it?
Yeah, we invested in a company in the healthcare space, where the CEO and founder is a woman. And the metrics speak for themselves. The business, she's done an incredible job of building the business, very capital efficient. The business is far larger than anyone would have imagined. And we spent probably 2 years, begging her to, take our money and allow us to invest. And so I do think that, at a certain point, like the numbers don't lie and the metrics are there and pretty clear. And I think we were thrilled to make an investment and, thrilled to continue to support her. I'm sure there were dozens of investors that were begging her just as we were, to take their capital. And so, I think that, sooner or later you get to a point where just the metrics are so clear and obvious that, you've built something really special. And yeah, I mean, we weren't doing very early stage investing. And so,
Yeah.
we were kind of investing post product market fit. And so, we had always liked this category, but actually hadn't known the business, up until, the couple years before we invested. And so, it was a great opportunity for us. And I'm sure dozens of other investors were hoping to get the same opportunity.
Coming from your experience, one more question I have is, when you must have seen several founders presenting in a very different and a unique flavor ways. But is there any example that you have, kind of, taken it to you as a founder that, oh, this was a marvelous example how somebody should be pitching, and you saw that unconventional style of pitching versus what general ways of pitching goes, or how somebody prepares for their pitch decks, or like presenting methods. Is there any outstanding example that you have that you like to share with our club, who would like to take that further and be more creative, and because not every time you're gonna hit the right balance sheet.
Yeah, and I would say, first and foremost, it has to be authentic, right? So if you are the type of person that really is more comfortable presenting off of a deck, then I would say stick with that, right? Like don't, because at the end of the day, you're optimizing for trying to create something, authentic connection and come across as someone that is trustworthy, right? That's by, maybe just stepping back a second. One of the things that I would tell founders to think about is not how can I sell this company or idea, but how do I find the right fit, right? And I think there's an element of that is about relationship and mutual trust, right? At the end of the day, you're looking for an investor who you trust to be an owner and shareholder in the business,
Hmm.
and they're looking for a CEO that they trust with their capital, right? And so there's many instances where the answer you may want to give may be more polished and maybe slightly less authentic. And I always encourage founders and CEOs, give the authentic answer, because at the end of the day, you build more rapport with someone when they view you as being trustworthy than you do when they view you as being kind of scripted, right? And so, I think the presentation mode should be authentic to the person. The things that I've seen be very successful or the most successful is I'm a big fan of trying to hook the investor in the first few minutes
Yeah.
with the excitement or momentum around the business. I don't think you want to wait until you're 20 minutes in, to kind of talk to them about why this is compelling or why this is interesting now. I think you want to hit that right on the head. I also encourage, folks to talk about their team. Sometimes like the slide with logos of where people came from doesn't really do justice, right? If someone on your team, was the, C chief product officer of a really relevant company, talking about, hey, here's what they built, here's what they managed, talking about those accomplishments is really effective. And then the last thing that I would mention is product. I think often, look, I've seen founders not even mention or touch on the product at all. I've seen founders put screenshots in. I think there's no substitute, especially for something that maybe is more complicated or is more novel. There's no substitute to like jumping out of the deck into a live product or, a staging environment and saying, hey, let me just click around and just show you how this works, help you get a feel for what we're doing, why it's different, why it's interesting. And so I'd become very comfortable with taking people through product demos and using the product demo as a means of increasing their understanding of the problem and the solution.
Interesting. So this is something, I mean, there is no such, there is no formula with which somebody should be presenting. I mean, especially when you were looking out to the latter stages, the product has proven certain revenues have already walked in. And after that, I think it's still a simpler game to scale up, but it's still not simple because, you have to prove to that metrics and, your marching journey, the future mapping should come very solid, and that's not an easy compared to what the prior to series A, I would say.
Mhm.
So with that thing in mind, like, when you go to the higher series rounds, your boards are going to change. The VCs who are going to bet on you with the more investment is likely take up the board seats. So, is there any advice as a founder that you have when, somebody is doing the due diligence of raising the capital, but at the same time giving up the board seat? What are some of the important factors to look into as a founder so that you don't compromise with your original vision that you bring in because you are an expert in the field, you have thoroughly studied the field, you've thoroughly, checked the market. So now you don't want to dilute it in a
Yeah.
way because somebody just heading up with the capital.
I think a few things come to mind. So the first is references go both in both directions. I would do references on the investor. Particularly, I would try to talk to people, obviously where the investor has been on their board, maybe where things didn't work out as planned, right? Companies that didn't work, as you know, in addition to companies that have been successful and worked. But, I think often people show their true colors in situations of distress or, of difficulty. And so you want to make sure that you're talking to people that have seen that investor in situations of difficulty, right? And you want to probe, even with the successful founders, right? You want to probe, like, hey, have there been instances where there was disagreement? What is this person like on the board? What if there is a challenging conversation or topic, right? How have you handled that, right? You want to try to get specific examples or stories from those founder reference calls that you're doing, right? I think the second thing is post diligence. If this investor has agreed to invest, you've signed the term sheet, now the investment is closed. One thing that I think is really effective is having a one-on-one with that investor to say, hey, I'm curious, you guys just did a bunch of diligence on the business. What are some, things that came out of the diligence, both positive and negative, that you would want to share with us, right? And understanding where maybe they had questions, maybe there are some things that are still unresolved, right? That they're looking to get more finality on or more, evidence on. And really just opening the door to that type of conversation around, hey, what were some of the questions that you guys were trying to answer? Were there still issues or open questions that, we can help resolve, right? And then the third thing is I would use the first board meeting to really align on objectives. And the objective is not what your plan, your fiscal year, financial plan is going to look like. It's really, what do we want to achieve with the capital that we've raised? That could be profitability. That could be, we want to get to the next round of capital. And here's what we need to be, in terms of the business to get there. And usually from that will come even finer objects, right? Of, hey, if we need to get to 10 million of revenue to raise the next round of capital, what do we need to get to 10 million of revenue? Well, we need to hire a GTM leader and, we need to prove out our enterprise, go to market, whatever it may be, right? But usually things will come out of that conversation that not only give you the sense of what do I need to go and accomplish, but it aligns everyone on the board to say, hey, this is what we're signing for, right? And ultimately, if when I invested, I had, a belief that maybe the business could get here, and now the management team thinks that we can get here. It's much better to get those out in the open as quickly as possible and reconfirm, the alignment than it is to, hunt on that and let it, let that issue come up, 18 months down the road.
So do you think these conversations or these type of meetings should be led by the founders intentionally or the CEO at that particular point in time?
Absolutely.
Okay.
Absolutely.
And when, you just listed about your experience with the Nature Box, and you mentioned that, for 6.5 years, you kind of laid as a CEO position to the company. But at the same time, the time came and you decided to give away that CEO-ship to somebody who would, take up that role further or, expand on whatever that exists today in terms of scaling up. I mean, there could be personal reasons for why you wanted to step down, but there is always a time that when companies are scaling up, sometimes the founders have to take a backseat.
Mm-hmm.
And I think you are the phenomenal person to answer in here that, when such decisions have to be made. Because oftentimes when raising Series A, Series B, the VCs would directly question whether you like to step down at this particular point and would like to bring in someone who can do, much more justice to the scaled up journey.
Yeah. Look, I think the hardest part is there's so much ego to this, right? Of, I'm the founder or CEO, I should always be the CEO kind of thing. I think in my case, I was tired and I feel that a lot of companies, end up, many companies fail because the founders run out of gas, right? And I do think that it's really important to be self-aware to say, hey, am I passionate about this? Do I want to keep running up the hill? And there's nothing wrong with, being realistic about maybe that's change. These are long journeys. It's pretty rare to have one person for 10 years of their life, 20 years of their life run up the hill, right? And so
Yes.
often people do, their passions change, their interests change. And so I think one aspect is you have to be self-aware about that and realize that, listen, what you don't want, what the company deserves is a CEO that has the energy to, grow the business, lead the business. And if you feel like you're under delivering on that energy, then it may not be the right time for you to be CEO anymore. I think often CEOs in their heart of hearts know, when maybe they're not being as effective or it's time to, step away. I think one of the challenges is that boards tend to be really bad at navigating transitions and talking about economics and, like having, the CEO, the current CEO figure out what their new role is going to be if they stay with the company at all or not. And so I do think having a board member investor that you trust, that you can talk to about some of these things, right? Maybe it's economics, maybe it's a transition plan, whatever it is really important. And I think often boards are pretty bad at that, unfortunately. But yeah, that's been my experience. I think it's a very difficult thing from an ego perspective to say, hey, I would like to take a step back. It happens, I think unfortunately, sometimes there's not a mechanism for, CEOs to sort of, yeah, say, hey, I'm tired and I'd like to move on.
Yeah, it's a complex problem to solve in a way, although there is a good experience that comes with it. But when you touch base on the board, I'd like to ask, now that you are looking forward for your next journey, pausing at a TCV Velocity Fund, which kind of had a good run, kind of, did much more justice to earlier companies after the product market fit versus what TCV was traditionally investing. And, you kind of brought down that to little bit of early stage and then growing up with them. Now you're looking at to venture out something else. I like to touch base on that and would like to know what are your next journey looking at, whether it will be still continuing into the investment part or looking out for new products. What are your plans? And if you're looking for the investment journey again, what is that you're gonna do different this time versus the prior experience?
Yeah, so I'm still thinking through exactly what's next. But I love working with founders and helping founders. I love helping founders avoid some of the mistakes that I made as a CEO. And so I do know that it will be whatever it is, it will be, very much in the scope of working with founders on helping them scale and accelerate their business. I think the world is really changing where, AI is enabling companies to go after bigger opportunities and operate more efficiently.
Yeah.
And I think that the current product of venture capital needs to change. The seed industry was born 15 years ago because Amazon Cloud, AWS, software as a service, all of these things made it cheaper to start a company, right? And get a product to market. And I think the same changes are underway today that will help a company not just start, but grow in a much more capital efficient manner. And so, 15 years ago, none of the seed firms that we think of today even existed, right?
Hmm.
That entire asset class had been built because of cloud and more efficient technology. And I think we're going to see that same disruption happen again, where there are going to be different models for how you build and scale a company. And I'm excited to kind of go further in that vein.
Okay, so again, we may look for as Gautam as another investment or bringing up another funds for us.
Potentially. Stay tuned.
Okay, okay. So that's the message for our founders community. If you're looking forward like something innovative to happen with a lot of experience, I think there is, I mean, there are multiple shops where you could go and find out, the new VC firms, but, always that experience brings a different wisdom altogether. And also that perspective, changes how you essentially mentor someone. When you're looking forward to dilute your equity based with the investment or funding, then you better want to, we have the alert decisions. And at that particular time, this experience as a founder also helps. So I'm sure that new journey that you're taking up, Gautam, is going to be, phenomenal. And it's much more meaningful shaping the founder's journey versus just growing the funds.
I appreciate that. Yeah, no, I'm very excited and look if I can be helpful to anyone in the community. I would love to be.
Yeah, best luck for your journey. Well, we'll move on to the rapid fire, and then we'll have a surprise question that our founders
Sure,
community has poured in, and of course, the advice question.
of
We'll go
course.
quickly. The first question on the rapid fire that we generally ask, all our guests is one favorite book that you'll recommend to our founders club.
One that I think is phenomenal is called Who, and it's a method for hiring, WHO, Who, and it's a amazing book around that gives you a framework around executive hiring, and just how to become more thoughtful and more disciplined as you think about hiring and scaling your team.
Hmm, interesting. Also, thoroughly on your blogs, I do see postings about, how to be a better leader or, what you should be doing next in terms of a CEO role or, different hiring models as well. So I think it's more or less your interest is lying in mentorship now.
Mhm. Yeah, absolutely.
Yeah. What is one biggest risk as a VC you took?
It's funny because I always say every company has the risk of going to zero. Even in businesses that have revenue and even profits, there's always a risk, right? That the business could be supplanted by, the next great technology. Look, I think the biggest risks you often take are around people, because this job, in an ideal state, you get to know a founder over multiple years because you're tracking the business, tracking the investment. But in some cases, you have to move very quickly, right? And within 30 days, you're signing a term sheet. And so the biggest mistakes and risks tend to be around people, just not necessarily having the depth or discipline that you maybe hoped or thought when you were diligencing. And it's really hard, to know that in advance. So unfortunately, that those tend to be the biggest mistakes.
When you talk about the AI and the lean startups, yet there is, what is that one skeptical trend that you think is what you say, like you're very skeptical about one trend. Is there anything that you have from your experience or your observation or market research?
I'm still skeptical on crypto. I am just not sure. Like, I think stable coins, there are interesting use cases. I'm not sure there are real use cases around most blockchain applications that couldn't just be done in a more centralized manner, and likely be, more cost effective, more efficient. So I'm still skeptical about crypto as a whole.
Okay. From the founder side perspective, what is that one challenge that you see essentially founders face while building their own communities?
Founders face a lot of challenges. I think one of the biggest um, issues that is not really a challenge is, I think founders tend to have the aspect of, oh, I can't talk about, issues in the business, or I can't, I have to, sort of give this vibe that everything is going great. And I actually think that that's not true. I think the world conspires to help you. And the more that you're able to talk to people about challenges, issues, what you'll find, I think, is people, going out of their way to be helpful. And, to make that introduction, that you needed, or to, kind of step in, and provide a bridge financing or whatever it may be. And so I do think that that's one of the mistakes that a lot of founders make.
Hmm, interesting. Essentially, like being vulnerable and exposing that side of it.
Exactly.
Wonderful. I think it's that leads to many other problems to the founder's journey in general, personal as well as the professional latter stages. But it's good to, that you have highlighted that particular angle, that the mental health and the well-being stand on those points. And it's, essentially one or the other side of your life is not going to be balanced when you're growing the company as a second. Yeah. The one common myth that you think, like, the founders should get, or rather wish that the founders should have insight on about the VC firm, like, what is the common myth that the founders possess as a VC firm when they're doing the fundraising?
That each VC that you meet with can unilaterally make investment decisions. Most people have an investment committee. They have to then go sell your idea to a committee of people that you've never met. And so even though you might have a great conversation with that investor, you have to be, cognizant of their job is now to take what you just discussed and position that, internally. And so that's one of the things, I don't know if it's a myth per se, but I think it's one of the things that people don't understand. They don't know about the process.
Interesting. And also the portfolio balancing, right?
Great example. I had a business in the logistics space, and I was talking to another company in that space. I really liked the founder, but the thing in the back of my mind was, well, do I want two investments in the logistics space?
Hmm.
And that's nothing against the founder of the company. It's simply that, they got their second, right? And, I already had an investment that was close enough, not competitive, but close. And I sort of felt like, oh, maybe I don't want to have two investments in the same category or the same industry.
Yeah. So essentially, the funds are structured in a way to, grow somebody else's money. That is something founders should not be taking it on a personal end. But of course,
Sure.
those reasons that you're talking are not gonna be, visible to founders. And essentially, what happens is it demoralizes many a times the founders, especially the big firms are walking away from them.
That's right. Absolutely true.
Now we'll move on to the surprise question and then to the advice question. The surprise question that has come is from the founders community. Somebody on the development of a product has asked a wonderful question that we have picked today. And I believe that they are building something in AI, and that's where these questions have essentially laid up to. Now that the AIs are disrupting the product and how essentially the companies are built, so does the VC world is going to get disrupted. And sooner or later, we're going to see a lot of bots which are actually validating the ideas, taking baits, and essentially how the funds should be structured or whom to approach, rather than there will be some people who will be actually the human angles basically are going to get evaporated. So what are your takes on the future VC world looks like? Because those tools are just getting built out and will do much enhanced jobs than today versus 2% of VC baits are gonna come true. It's gonna be almost 80% are gonna come true because it is much more deep understanding way that somebody is gonna invest. Because today a lot of VC firm representatives might not be that techy or experts in the industry where the pitches are, or somebody is approaching to them. So
Yeah.
what take on it?
Yeah, I think look, AI will affect all industries, venture included. I think the biggest impact is that some companies will just require less capital, and so the size of the venture industry, is still it's very unclear to me. Will the industry grow or shrink actually, right? Because companies can achieve more with less. But yeah, in terms of the internal operation, I do think firms will leverage AI from a sourcing perspective and a diligence perspective. Those feel very clear to me, which is, you'll find investments because you'll have agents, looking for relevant companies, looking for companies that maybe fit your thesis on the world, all of those things. And then the second piece is, doing diligence and like double clicking into businesses. that, finding the research and the intel and maybe even doing interviews with customers and things like that, all in autonomous ways.
I think that will decentralize many things, and traditional approach of raising money and everything is gonna fade away. It's ultimately what you're building on will matter the most versus I think it's gonna take a lot of founders' anxiety and time from building the company in terms of a fund specific, like raising the funds, and versus as you rightly said earlier, like one or the other founder has to do that due diligence of making company ready for the fundraising, and one has to be constantly active at it. That is gonna get fade away, and versus you'll focus more on products because it's gonna be on autopilot basis.
Yeah. Yep. That's right.
Yeah, it's a amazing challenge and amazing time to be in as a founder, as a VC, and both ways.
Mhm.
Now we'll move on to the last advice question. Prior to that, I'd like to thank you, Gautam, that you have
Course.
been, the conversations has, unfolded in a very meaningful way, especially from the founder's eye point of view and as an investor point of view. You have unfolded many myths, and also I felt this was a masterclass for someone who is really looking forward to build a company and not having right access to the network at this particular time.
I appreciate it. It's great to great to be with you guys and would love to help the community. So
Yeah, sure. We'll knock your doors again. But before you go, I would like to have an advice question. Now that from the founder's point of view, where you actually raised 70 million and have taken box at certain level, and from the investor point of view, where you roll the tables multiple times, what is that one advice piece that you have for the first time founders to build a robust company and take it to the IPO level?
yeah, the one piece of advice is focus. I think this is the biggest mistake that I made was not being focused enough. Say no to all the distractions, right? When you're building a company, there's no limit to interesting opportunities that you're going to come across. And you just have to stay really focused on the core.
That's a very difficult job though, because once you start
Very
figuring
hard.
out
Yeah,
any
simple but hard.
yeah, because many channel partners would start walking in, many collabs would happen, and you essentially your time to look at every opportunity, study every opportunity is start shrinking.
That's right. That's right.
Well, it was wonderful to have you, Gautam. I'm sure you'll do best in your next move, and we are looking forward your next move. When the time comes right, we'd like to give you a shout out on your next move. Do keep
Appreciate
us
that.
posted about it, and stay in touch with the Passionate Pulse podcast.
Awesome. Thank you for having me. Appreciate it.
Thank you. Thank you, Gautam. Nice to meet you.
Likewise.